Okay, so good evening and welcome to the session this evening as we look at this comprehensive master revision masterclass on financial reporting and corporate reporting for our examination tomorrow, 9 a.m. and 2 p.m. respectively. And my goal in this discussion is to help you and walk you through some few things that you need to be mindful of and be aware of generally as you position yourself to pass the examination. And so we are live on YouTube, we are live on Facebook, we are live on LinkedIn as well, and then also here on Zoom in that case. So first things first, if there are any questions, something you want to pick my brain on quickly, something specific that you want to pick my brain on very quickly, those of you with me on Zoom, you can raise your hand. I'll bring you up, or you can put it in the chat for me. Then the rest of you online with us, you can put it in the chat for me, and I'll be excited to provide you with some answers. So I want to quickly see and take some questions from you guys. If there is anything specific you want to pick my brain on, you know what is going to be in the exam hall: consolidation, the standards, single entity financial statement for FR students, financial reconstruction, corporate reorganization, business valuation for corporate reporting students, evaluation of financial statements, and then certainly some theory issues coming up. So if there is anything specific, you can put it in the chat for me, or raise your hand. Those of you with me on Zoom, then I can bring you up in that particular case as we look at what we can walk ourselves through in the discussion this evening. Okay, so I think I'm seeing a comments coming up here. Let's see if I can pick that quickly, then I can go. Now my comments pulling up. Okay, so Vivian Fosua said, please can share something on the mock that was shared. You mean, can I share something on the mock that was shared? What should I share? The mock is just a question sent out to students to have an idea about how your exam is going to be generally. So if there is a specific question you want to ask about it, fine. But there is nothing to share than to say that it is just to let you know how the exam is going to be like as you are going into the exam hall tomorrow. So that's all I can say about the mock. If there is anything specific, as I said, then probably you can let me know about it. If not, then we can get excited and then go into the discussion. What else do I have? Blessing said good evening. Said yeah, good evening. Ewuzi said good evening. Yeah, good evening. So if there's any specific question, can raise your hand. I'll bring you up, or you put it in the chat for me, and I'm going to be getting excited into my discussion as well tonight. And so we know what exactly is going to be in the exam hall tomorrow as we are going into the exam. The question is, how the heck are you supposed to approach what is going to be in the exam hall? And then what must you do in order for you to really pass the examination? So what I want to do tonight in the next few minutes, maybe, I don't know, an hour, 45 minutes or whatever the heck, I don't know how far I'm going to go, is to take you behind the scene, number one, and then give you some blueprints so you can take with you into the exam hall tomorrow morning, 9 a.m. for FR students, or in the afternoon, 2 p.m. for the corporate reporting students in that particular case. So what I'm doing is to give you some blueprints that you can take directly into the exam hall to pass the examination. The first thing that is going to be in the exam hall, it's going to be evaluation of financial statement. Whether we are in corporate reporting or financial reporting, we are going to be seeing interpretation of financial statement question there. Now, when it comes to this aspect of the question, we're going to have maybe 15% or 20%, depending on how excited the examiner is. So either 15 or 20. There are 5 things you have to understand when it comes to the ratio question that you are going to see in the exam hall. 5 things. The first thing is to identify the type of questions that the examiner is likely to bring. And for those of you in the corporate reporting class, we've discussed this. There are 6 types of questions when it comes to ratios that the examiner can bring one of them in the exam hall. 6 types of ratio questions. 6. For those of you in the financial reporting class, probably 4 types of questions from which the examiner can bring one. The second thing you need to understand is the basis of comparison, because when we are analyzing the financial statement, it is important we know whether it is the same entity year on year or 2 different entities, or the entity and the industry average or industry data. That is very important because that then will guide us on the choice of words that we are going to be using, whether something is increasing, decreasing, rising or falling, whatever the heck. Then the analysis format. There are 2 options available. Either the examiner is going to say, hey, just analyze the financial performance and position of the entity, blah, 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 we go. Or write a report. So format is key, we need to understand. Then interpretation guidelines. How do you actually write out the interpretation? Very important. And then the 5th thing is going to be the theories. And there are 2 types of theory questions that the examiner can bring to you on the ratios, and that is limitations. When it comes to the limitations also, there are 2 types of limitation questions. The generic limitation question on ratios. So what are the limitations of ratio analysis? It is based on historical data. The performance in the past cannot be used to predict the performance in the future. The financial statement may be manipulated based on the accounting policies and principles that the entity is using and all that, right? Then there is a type of limitation question that the examiner can bring to you where it is being contextualized in the question. What does that mean? It means that maybe an entity is seeking to go and acquire another entity. And we saw this during our mock examination. And we are analyzing 2 different entities so that our predator firm can decide which of them to acquire. Then in that type of question, you saw there was limitations. So what are the limitations of the predator firm using the ratios of the 2 companies to decide which of the 2 companies to acquire? So that context of ratio question is also something that you need to be mindful of in that particular case. So these are the 5 things that we have to be on the lookout for generally when it comes to ratio analysis. So let's take them one after the other and share some thoughts on them quickly as we go into the discussion. The first thing is the types of question. I think I've discussed this with you during our closing session, I think on Friday, if you remember. But there are 4 types of questions for the financial reporting students, and then 6 types of questions for the corporate reporting students. Let me quickly go through them, give you some guiding principle, because remember, as I said, I'm giving you a blueprint that you can walk into the exam hall with. So let me go again to my slide. Oh, sorry. Let's see if I can get my slide. There we go. So the first type of ratio question is where you don't have to sweat. A financial statement is given to you. The examiner says, analyze the financial performance and position of the entity. No problem there. So all you do is to calculate some profitability ratios, asset turnover, net profit margin, and then ROCE, return on capital employed. You come to the liquidity ratios, current ratio, quick ratio. You come to the efficiency ratios, asset, inventory turnover, and those things, and do the calculation. The only thing I want you to be mindful of is the context of the question. There are a couple of options available to the examiner. Number 1, you remember that when it comes to inventory management, there are 2 types of ratios that the examiner can access to use. 2. We have the inventory turnover. So we have the inventory turnover, and then we have the inventory turnover days or period, or inventory holding period. Period or holding period. They are all measuring the same thing, the efficiency of the inventory management system of the entity. But it is important you understand how to calculate them and how to interpret them. If we are in inventory turnover, then our idea is going to be the cost of sales divided by the inventory. Sometimes it could be average inventory. And you will use the average inventory when we have opening and closing stock of inventory, because average inventory is opening plus closing divided by 2. Right? And there, our answer will be in X times, because the inventory turnover is measuring how quickly the entity is able to sell its inventories. And the rule here is that we expect this ratio to be higher, to be greater, or to be rising, whatever the heck it is. That's it. Because when it is higher, when it is greater, when it is rising, when it is increasing, then it means that the entity has an efficient and effective inventory control management system in place. In other words, they are selling inventories as quickly as possible. Alternatively, we could do the same thing using the inventory holding period. In that case, we will have inventory, okay, or average inventory, the same concept here, divided by your cost of sales, multiplied by 365 days. So here your answer will be in days. And for this one, we expect the ratio to be lower, to be less than, or to be reducing. Because that is the principle. Now, the two of them are all measuring the same thing. So if, for instance, the question is quiet and it says, analyze the financial performance and position of the entity, and you're going to calculate inventory management ratio, only one of these you will use. But you have to know how to interpret them and how to do the calculation in respect of these ratios. So only one of them can be used because technically they are all measuring the same thing. But the principle is what you have to go away with very well. The second thing that I want you to be mindful of when it comes to the calculation will be the issue about where there is lease obligation in the question. And you know, I've emphasized on this over and over again during our discussion of the ratios, when there is lease obligation in the question. Where there is lease obligation in the question, the examiner may tell you that in the calculation of your ROSI, and then your gearing or gearing, the lease obligation should be treated as an interest-bearing loan or should be part of the capital employed. What it means then is that when you are calculating ROSI and the gearing, then your capital employed is going to be the shareholders' fund, which is what is under the equity, plus the long-term debt. Remember, it is interest-bearing debt. Then you are going to be bringing in the lease obligation, and that is both the current liability and the non-current liability. That is how your capital employed will be. For ROSI and gearing, the examiner will tell you, so you don't need a miracle on this one. He will tell you that in the calculation of ROSI and gearing, the lease obligation should be treated as that. So if he wants to dance like that with you, then he's going to tell you exactly what you are expected to do here. That means that when you come to the calculation of the asset turnover ratio, you're not going to use the same capital employed you used in calculating ROSI and gearing. Instead, when it comes to the asset turnover, you're going to be using the normal default capital employed formula, which is your total assets less current liabilities. Your total assets less current liabilities. So that is also another key principle that you must understand when it comes to the calculation of the ratios. Another key principles that you have to understand when it comes to the calculation. Aside these two extreme guys, the other ones are default thing that you should be able to work yourself out, calculating gross profit margin, net profit margin, the investors' ratios, earnings per share, dividend per share, P ratio. I mean, you should be able to calculate those things. So the really area where there will be some level of exclusivity and you have to be careful will be where there is leasing in the mix, and then you have to find out which of the inventory management system or which of the inventory concept you have to use to calculate the efficiency and the effectiveness of the inventory management system of the entity. So that is very important there. These two calculations, you pay attention to them. It will depend on the context of the question. As I said, you will only apply this concept here if there is lease obligation in the question and the examiner so chooses for you to do it. Okay? So it will be stated. In the inventory, the examiner will say one of them. If he is quiet, you choose one, and then you go with your analysis or you go with your calculation in there. So these are the two things that I want you to be mindful of when it comes to the computations. Okay? When it comes to the computations. But as I was saying before coming to the calculation workflow here, the examiner can also bring us a question where there is an acquisition during the year. So acquisition at the beginning of the current year. Okay, at the start of the year. Stay with me. What does that mean? It means it is the same entity we are analyzing year on year. But last year, maybe 20X5, it was a single company. This year in 20X6, it is now a consolidated company because they have acquired a company. Now, you got to be mindful here because, again, it depends on the context of the question. The examiner may not give us the financial statement of the subsidiary that they acquired, their revenue and things so that we can amend. In that case, you're just going to go ahead and calculate your ratios the way you know. But in your interpretation, you would have to highlight the impact of the entity that has been acquired on the increase or decrease in the ratios that you have calculated. Very important. Very important. However, if the entity acquired, their P&L is given to us, then in that case, we will readjust the consolidated financial statement for the current year by removing the subsidiaries' revenue, cost of sales, so that we can have year on year on the same basis. In that case, you are going to calculate three different ratios. You will calculate the ratios for the single entity, calculate the ratios as reported as a consolidated financial statement. Then you calculate the ratios by eliminating the subsidiaries' financial statement from the consolidation, and that is how you are going to be doing the analysis. Again, it depends on the context of the question. Don't freak out. It depends on the context of the question. Another dance is where there is a disposal at the start of the year. That's another type of question the examiner can throw to us. And so last year, there was a whole company. So 20X5, it was a complete company. Now in 20X6, we just have part of the business in that particular case. So it means the previous year financial statement includes the segment that has been disposed of. And so in that case, the examiner will give us the information about the segment that has been disposed of relating to the previous year, so that you come and adjust the previous year's financial statement by removing the segment that has been disposed of at the start of the current year. Then you can now calculate the ratios to be able to do the comparison. That is also another type of ratio question that the examiner is going to may bring to you in that case. Again, my goal here is to tell you about the options as I did earlier, and then crystallize on the principles that you're going to be applying generally. So either we're going with a default, or we have an acquisition, we have to make an adjustment, we have a disposal, we have to make an adjustment, boom, we gone. Or what is my favorite, where we will have to amend the financial statement by applying some IFRSs to the notes. So the examiner is going to give us a draft financial statement. Then the notes will have some things that we would have to adjust for in the financial statement before we calculate the ratios. That is also another option available to the examiner. Again, there is nothing new here. The examiner is just testing your IFRS strength. And so you will read the footnotes, apply the IFRS principle, and prepare the financial statement. When you are done, you come back to auto reset, calculate your ratios, do your interpretation. There you are. You are done. You are done. So it's not anything new. It's just an option available to the examiner in the exam hall that you have to be aware of as you are going into the exam hall tomorrow. All right? As you are going into the exam hall tomorrow. Then the last two things will be the issue about common size analysis. All right? And I've given you the guidelines on the interpretation of this. You can also find it in the summary video segment. But common size analysis, or what we also refer to as vertical analysis, is where the financial statements have been presented into percentages. So the statement of profit or loss and OCI in percentages, where total revenue becomes the basis. So for each of the line items, they are expressed as a percentage of the total revenue. And so I mentioned the principles about how you interpret this. Make sure you review that. And then the last thing, which is exclusive to corporate reporting students, will be the issue about cash flow analysis as well, which is what's another option that the examiner has that you need to be mindful of. Again, we've spoken about this. I've given you the principles. The summary video in the mobile application also, you can refer to that. The principles are explained there to guide you. So that is the first thing you must understand, the type of questions available to the examiner, the option. One of these will be in the exam hall tomorrow as you go. Which one? I don't care. And you shouldn't even care about it. All you have to know about is, what are the principles? How do I go about such questions? That should be your headache. And that is what I'm trying to do here, about how you go about the question in order for you to do your calculation and, most importantly, interpret the ratios. So that's the first thing you must understand, the type of questions available. Second thing, which is the most important thing, because you can calculate your ratios right, but if you screw this up, you get 0 on the analysis, and that is the basis of comparison. Now, there are two bases of comparisons that we can have generally. Either we are analyzing the entity year on year, the same entity year on year. In that case, you can say, oh, it's increased, it's reducing, it's rising, it's falling, it's greater, it's less, it's whatever the heck. You can do whatever the heck you want to do. The same entity year on year. But if it is the entity and we are comparing their financial statement with another entity, you got to be careful about your choices of words, because nothing is increasing here. You are comparing two entities. You can't say, oh, the gross profit margin during the year has increased from this to this. Bruh, you are already in the mud. It's 0. You are comparing two different entities. Nothing is increasing. Nothing is reducing. So in that case, what do you say? Either it is higher or greater. Or the KG2 English that I say you shouldn't be saying, which is, oh, it is better than this. But I've told you, that's KG2 English. Don't go and write it in the exam hall. So the basis of comparison and your choice of words, it's also very important for you to understand. And that is something you need to know about. Immediately you see the question, you should find out, what's the basis of comparison here? If not, you may be able to do your calculations right. which is also a problem because some people cannot even pick the figures up rightly. Now, if you get a calculation wrong, forget about the analysis. So you have to be careful here. But the basis of comparison is very important. And that is the second thing you need to understand, because that guides us on the choice of words that we are going to be using, whether something is increasing, decreasing, greater or less, or whatever the heck. The third thing is the guiding principle for the analysis. Please, some of you have gone through, you've written some analysis, I've done correction, I have reprimanded you over and over again. Don't go screw yourself up in the exam hall. The basis or the guiding principles. How do you write out the analysis? Common size analysis, you have the principles already. Cash flow analysis, you have the principles already. The rest of the 4 other types of ratio questions, this is how you write out the analysis. 1, briefly explain the ratio. What are you looking at? Again, briefly. So if it is ROSI that you are looking at, return on capital employed measures the returns that the entity is making on the capital that has been invested. Or it is the return generated from 1 Ghana cedi of capital invested. Or it is the return generated on the providers of finance capital. Sweet, simple, straight to the point. Then state the change. Is it increasing, decreasing, based on the basis of comparison? Is it increasing, decreasing? Is it less than or greater than? Then why? What are the possible reasons for that? Please, don't go screw yourself up by writing something that doesn't exist. So be careful. And we've given you guiding principles, and we've gone through your script, giving you guidelines on how you go through with this interpretation. Be mindful to state reasons that either can be contextualized in the question given or generically suit the context of the question. Again, it's a very, very slippery area, but you got to be mindful of this. Why? Then the fourth thing, which you may not be able to get there, but if you are able to get there in your analysis, fine. That is to briefly explain the possible implication on the entity. But the first 3, it's a non-negotiable to be able to write out your analysis generally. The first 3, at least you can stay there. Please, do not make any recommendation in the analysis. So you are interpreting your ROSI, then you say, the ROSI has reduced. This is because the entity has, increased its capital employed during the year. The entity, therefore, or on the basis of this, the entity must put in place measures to be able to. Okay? Don't make any recommendations. Why? Because your recommendations will come in the conclusion paragraph. So just follow the deal. Analyze. In the conclusion paragraph, you pick 1 or 2 of the issues or challenges that you think the entity had based on your analysis and make some recommendations for that. You cannot make recommendations for each of the analysis that you are doing. It's not possible, so do not do it. So that is also the basis of comparison, and then the interpretation guiding principles. The last thing, which brings all these together, is going to be the pro forma of your analysis. If the question just say comment on the performance of the entity, comment on the performance of the entity, or analyze the performance of the entity, then just write your heading down. Analysis of the financial performance and position of the entity. Simple. Then you write your introduction. Write introduction. Then you write out your introduction. We've gone through this over and over again. It should be brief, simple, straight to the point. What the heck is this about? What are the bases of comparison you are using? What is the year ended you are analyzing for? In the introduction. When you are done, then you can begin your analysis write-up, which is financial performance. Do your analysis following the guiding principle, financial position, doing an analysis following the principles. Again, as we discussed in class, if you've built your strength in the ratios, you realize that it's going to be flowing naturally. And I told you that you start with revenue generation issue, so asset turnover ratios. And if you remember, I also told you sometimes you cannot use the asset turnover ratio. So in that case, you will use the percentage change in the revenue or the absolute change in the revenue. So you start from revenue generation, from the utilization of the capital or assets of the entity. Then you come to efficiency and effective control systems on the cost of sales of the entity, gross profit margin. Then you come to net profit margin. Remember that we drew a little difference between operating profit margin and net profit margin. Remember that. Remember that. I'm not going to talk about it again here, but remember it. If you have forgotten, go back to your notes. It should be somewhere in your notes. Go and look for it. But be mindful of that. Now, what does that mean? It means you start from revenue, then you will naturally flow to gross profit, then you will naturally flow to net profit margin, then you flow to ROSI. Now, so when you are interpreting your ROSI, you make reference to revenue, cost of sales, operating expenses. When you are doing the interpretation for net profit margin or operating profit margin, you make reference to revenue, cost of sales, and then the operating expenses. When you are interpreting the gross profit margin, you make references to revenue and then cost of sales. So if you follow that guideline, naturally your analysis should flow. And before you write the analysis, make sure you have it summarized down so that you can look at it as a whole, spend some 2 minutes on it, try to find out as a whole what is happening so that it helps you to write the point well. Because as you remember, some of you, when you were writing the ratios for me in class to mark, you remember that you were contradicting yourself. You remember, some of you remember that. You were contradicting yourself. So you said something in profitability, maybe gross profit margin, then you come and say the reversal of that in the net profit margin or the ROSI. On the overall, it means, where Diego, you're wrong. So have a summary of the ratios that you have calculated, look at it, spend 2 minutes on it, and find out on the overall what the heck is going on with this company so that you can form a certain planning analysis. Then you come and start your write-up. Certainly, you come to your conclusion paragraph. This is where you're going to be talking about the overall performance of the entity. And then this is the paragraph in which you make recommendations. What the entities can do to improve upon their performance or solve a certain problem that they are having. Please, again, if you remember in class, we said, do not write generic recommendations. The entity should put measures in place to increase revenue. What measures? Be specific. The entity should put measures in place to improve its liquidity position. What measures? So your recommendations should not be generic. They should be specific based on the context of the question. Then you will have your closer coming in. Thank you. And that is all. So when you are just supposed to comment, analyze the performance, the position of the entity, boom, that's it. Write your heading down. Don't write heading. Because some of you do some strange things that sometimes I don't even understand. Don't write heading. I mean, what are you doing? Analysis of the statement of financial performance and position. That is your heading. Don't go and write heading. Then you come to your introduction paragraph. Then you take the ratios. And again, follow the principles. Start from revenue, gross profit, net profit, operating, how is it called? Rosie. Don't flip it up. Because some of you, no matter what I tell you, you have your own dream. You have your own agenda. Then you go and screw yourself up. Because you've done that in class. I've corrected you, but still. Now, if we are supposed to write a report, right? If you are writing a report, then we need to also be mindful of the pro forma. For a report, to whom? It will be stated in the question. If you are not told who the heck you should write a report to, but the examiner says write a report on the analysis of the entity, then you're going to assume that the report will go to the directors of the company for the most part. Okay? Assume that the report is going to the directors of the company. From whom? You. If you're not given any title, give yourself a title, ICAG, final level or level 2 student, or financial analyst of the entity, something like that. Then the subject, what the heck are you writing on? Analysis of the financial performance and position of the entity. And then the date. The date should be whatever. Any day after the reporting date in the question, or in some cases, it could be the, how do we call it? The day on which you are writing the exam. That could also be done. Give me a sec. That could also be used. So pro forma, to, from, subject, date. Again, you follow the same things here to bring them in. Intro will come. Financial performance, financial position, will follow through like that. But then here, after your thank you, you got to have a closer, because it's a report. Yours sincerely or faithfully or whatever the heckly. Maybe you sign, and then you put your name down, Nhyira Premium, and you're done. The pro forma will be looked at before your analysis will be examined. That's how the marks is going to be or has been allocated. So pro forma is key here when it comes to this area in that particular case. So that's 20% in the syllabus analysis of the financial statement. The type of question, as I said, don't bother yourself. All you need to understand is what are the principles. And I've done that to you, explained them for you. The basis of comparison, is it the same entity year on year or two different entities? The pro forma of the analysis, is it a report or I'm just commenting? The interpretation guideline, very important. And certainly, objectives or importance of ratios, you make sure you read that very well. And then the limitations, and if you remember I said the limitations are in two folds that the examiner can bring to us. It could be generic limitation ratios in that particular case, or it could be the issue in respect of the context of the question, write out the limitation. So that's our 20 marks on evaluation of financial statement. And you're going to see that in the exam hall tomorrow morning or in the afternoon for corporate reporting students. Any questions about this? Those of you with me on Zoom, you can raise your hand, I'll bring you up. Or you put it in the chat for me. Then those joining on YouTube, Facebook also. If there's any question on this, 20 marks, you can put it in the chat for me. Let's see. I'm seeing some questions coming up. Let's see if I can bring in my comment box. Why is it important to determine if the firm is operating at full capacity or not? I don't know what the heck is that. Maybe give me some context on that so I can provide you with some answers. Also, run through what? Hedging. I'm literally blank. I don't think I'm going to be doing that. What is the best approach? Because I don't have time. So, what is the best approach to write a report? Can one compute ratios in appendix and write report after computation? Or a mix in the report? No, the analysis will be, the calculations will be separated as an appendix. Then your report flows seamlessly without having anything inside. So your analysis or report is going to be flowing seamlessly without any issue coming in. So your analysis will be as an appendix, okay? As an appendix. So that's why I said when you finish the calculation, have the total, like prepare another table that you have everything at a glance. Then that helps you to think through how to write out your analysis in that particular case. All right, so that is the idea about that in that case. Let me see if there is any other questions for me on this one. Okay, so that is from Alan. Let me know if that makes sense for you. So that's my first 20 marks area for you, ratios. The next area I want to get goosebumps on is your favorite area in the exam hall, 40% minimum waiting for you, and that is the accounting standards. What do you expect? IFRSs. 40%. Nah, let me tell you what the heck you're going to see. 45%. 45% is going to be based on the standards. 45. How is this split like? So let's work it out. For the FR squad, you're going to get 20% dedicated IFRS questions for you, maybe 4 sets of questions that you have to apply some standards, or 5 sets of questions that you have to apply standards specifically. Then the single entity financial statement, whether you are going to prepare the cash flow statement or the statement of profit or loss, changes in equity, statement of financial position. That's the other 20%. Then the examiner is going to bring a written part question also on the standards. That's 5 marks. That is why we have specific 45%. But this could be extended to 60. Because in consolidation, some of the footnotes, you would have to apply accounting standards. But on the bare minimum, we are starting with 40%, 45%. For our seniors, the CR students, dedicated accounting standards question, it depends on how excited the examiner is. You can have 25 to 30%. 25 to 30% dedicated accounting standards questions. And then we're going to have the written part, also 5% coming in that particular case. But remember, in consolidation, you'll be calling on the accounting standards. And then in business valuation and financial reconstruction also, you'll be calling on the accounting standards. So really, accounting standards play a crucial role here in your ability to be able to pass the examination. I'm not going to be able to walk you through all the accounting standards. What I want to do is to quickly just give you reminders on some of the specific accounting standards that I don't want to say you will see in the exam hall, but that you have to know about. The first one for especially the FR students is IAS 16, Property, Plant and Equipment. If you don't know everything in property, plant and equipment, you're going to be in a deep trouble in the exam hall. But I hope you know everything about property, plant, and equipment. It's waiting for you on the single entity financial statement preparation. So that one is a regular customer. What are the things you have to know about here? Remember the principle of the initial measurement. The initial cost of an asset shall be the purchaser's cost plus all other directly attributable costs incurred in bringing the asset to its present use. Remember that. Number 2, on the subsequent measurement, it is important you understand the various approaches available. We can use the revaluation approach or the cost model in that particular case. Whichever model we are using, depreciation can be done on straight line basis, reducing balance basis, sum of year date basis, or production unit basis. We've spoken about all of these. Make sure you know about them because the examiner can present you with whatever story he likes. The key thing I want you to take away here really will be the issue about the revaluation. Remember, when assets are revalued, then depreciation subsequently will be charged on the revalue amount. But it is important for you to understand when the revaluation is done. If the revaluation is done at the end of the year, no problem. You will calculate the depreciation for that year using the carrying amount at the beginning of the year, and you get your revaluation gain or loss. Treat it, that's all. But if the revaluation was done at the beginning of the year or midway within the year, then you would have to calculate depreciation using the revalued amount. So you got to be mindful on the timing of revaluation because that will influence or determine how you will calculate the depreciation. Note also, if it is first time revaluation and we get a loss, that loss is written off in the P&L account. If it is a first time and we get a surplus, that surplus goes to the OCI. If it is a second time revaluation, but in the previous year we have had a loss, then the second time revaluation, although it should go to the OCI, we will first recognize it in the P&L equivalent to the last year's loss. Then the excess amount is what will go to the OCI. Again, if we revalue subsequently and we get a loss, but previously that asset has a gain, then the loss will not go to P&L directly. It will be written off against the surplus in the OCI. The excess loss is what you will take to the P&L account. These are the principles that you need to understand when it comes to revaluation. Then certainly the last thing you must understand about revaluation is the issue about deferred tax implication. That when we revalue assets and there is deferred tax, note that the deferred tax must be recognized in the OCI in respect of the revaluation surplus. So the deferred tax amount that will go to the OCI will be the revaluation surplus multiplied by the tax rate. That is what will go to the OCI. And we've done this in class. During our mock session, we solved the questions and you saw the way those treatments will be done in regular class and during our mock session as well. So these are the things I want you to understand exclusively because revaluation is something that students struggle with. And so all the time, the examiner wants to play with it because students don't like it for some reason. So he always wants to play with it. So you want to make sure you understand these rules very well when it comes to the revaluation of assets. Then the last thing about IAS 16 will be the issue about transfers. Very important. When we transfer from PPE to held for sale, what is the accounting principle? When we transfer from PPE to investment property, what's the accounting principle? When we transfer from investment property to PPE, what is the accounting principle? We've discussed all of these. I'm just again bringing it to your notice that these are the things you have to know the principles about them. And if you go to the exam and there is a note, you know exactly how to treat them. So when it comes to IAS 16, these are the major things that I want you to be mindful of about IAS 16. As I said, this is a done deal for financial reporting students IAS 16 is going to be there. It's a note that will be there for you, so you better know how to handle it. If the examiner gets goosebumps, then you can also get it as a dedicated question, but it will be linked with another standard, either IAS 20, government grants, IAS 23, borrowing cost, situations there, or IAS 21, effect of changes in exchange rate. So we could have dedicated question, and it is a grant, it's a borrowing cost, it's an IAS 21, effect of changes in exchange rate, but our IAS 16 will be embedded in there, and you must know how to account for it under IAS 16, and you must know how to apply IAS 23, IAS 20, IAS 21 as well in that case. As you know already, the standards are intertwined. So it's not like, yo, I've learned IAS 16. Yeah, clap for me. They are intertwined, so you have to know about them in that regard. Then another fundamental accounting standard is going to be IAS 12. It's crucial for FR students, whether I like it or not, it's waiting for you. Income tax, I can guarantee you that it's waiting for you. So everything about income tax, you have to know about it, from, dealing with over provision and under provision, current tax provision, deferred tax, movement in deferred tax. You must know all of that. It's waiting for you. You can't run away from it, so you better know everything. Then corporate reporting students, in addition to those things, you know that there is a deferred tax implication on share-based payment, which is IFRS 2, share-based payment. And we've spoken about this. Yesterday, we even discussed it as well, if my memory serves me right, and on Friday as well. So please make sure you understand this as well, very well. The only thing you want to understand is going to be the context of the question. Because remember, in deferred tax, what we are doing is to compare the tax base to the carrying amount of the transaction or the item in question generally. And so it depends on the way the question is stated. And so you have to read the grammar to understand. If they say that, the tax base, is whatever, $2,000 in excess of the carrying amount. The tax base is $2,000 in excess of the carrying amount. In excess. What does that mean? It means your tax base is greater than the carrying amount, which means that is going to be a deductible temporary difference, which means that will be a deferred tax asset. So it's just the wordings of the examiner that you have to be mindful of. Other cases, he will give you the information, then you will have to do the calculations on your own and come up with what is happening based on the context of the question. All right? So deferred tax and movement in deferred tax is very important. Remember, by default, movement in deferred tax must go to P&L. But if you remember what I just said a moment ago, if the movement in the deferred tax is partly due to revaluation of assets, then part of that movement will go to OCI, then the excess will be taken to the P&L account. And if there is a revaluation surplus and there is a deferred tax implication on it, then when you go on the face of the statement of financial position, under the equity, the revaluation surplus, you are going to bring the figure you got minus the deferred tax liability which you brought in the OCI. That will be the net amount that will be on the face of the statement of financial position. So these are also some principles that you must understand when it comes to dealing with IAS 12. As I said, financial reporting student, you have no excuse on the standard. It's waiting for you. You're going to see it tomorrow 9 a.m. in the exam hall. IAS 16, you have no excuse about it. It's there waiting for you. At least these two accounting standards, I can guarantee that you're going to see it in the exam hall. It's waiting for you. So you better make sure that you understand these well. Then for corporate reporting students, you have to know it as well because it has a connection with one of the exclusive accounting standards here, which is the issue about share share-based payment when there is a deferred tax implication on the share-based payment. And as I said, we'll discuss these as well. Be familiar with the principle. Funny enough, the examiner has not really gone that far for some time. I don't know why. Always, if there is a share-based payment question, it's just the normal things you know. He has not brought deferred tax, really. So, I don't know. Maybe as this is the first examination diet under the no syllabus, he will want to venture into that arena. If I was him, I would do it. So, just make sure you understand the principle in that particular case. I'm not him, so, I don't have an authority on that. But these are the standards, basic issues that we need to understand. In addition to these, it is important we understand financial instruments, IFRS 9, IAS 32, IFRS 7. These are the three accounting standards for financial instruments. There is a high probability that you may apply this in the exam hall, financial instrument. It's an interesting standard that you must know about, okay? So what do I have to do? When it comes to IFRS 9, it talks about financial instrument recognition and measurement. And so there are some key words that you need to understand. You have to ask yourself, as you read the question, the entity in whose books we are preparing the financial statement, are they the one buying or they are the one selling? Are they the one purchasing or they are the ones issuing? Are they the one making the investment or they are the one raising the investment? Why? Because if we are the ones buying, we are the ones purchasing, we are the ones making the investment, then you are going to be recognizing financial assets. But if our entity is the one issuing, selling, raising money, then we may be thinking about financial liability or equity instruments. Now, if it is a financial asset because we are buying, we are the ones making the investment, then it is important we understand what are we buying. We could buy two things. Either we are buying a debt instrument or we are buying an equity instrument. If we are buying an equity instrument, there are two ways the entity can carry it. They can carry at fair value through P&L or at fair value through OCI. The distinction is simply simple. It is in how we treat transaction cost and then fair value movement by the entity. Transaction cost and then the fair value movement. If we are doing at fair value through P&L, then the transaction cost incurred whilst purchasing or making the investment will be recognized in the P&L. And any fair value gain or loss will also be recognized in the P&L. But if we are carrying the equity investment at fair value through OCI, then what is going to be happening is that the transaction cost will be included in the initial measurement of the investment. Then on subsequent measurement, any fair value gain or loss will also be recognized in the OCI and also taken to the statement of financial position under other components of equity. So that is what we need to understand. If the entity bought a debt instrument in that particular case, the same rule apply either at fair value through P&L or at fair value through OCI if the debt instrument is treated or traded on an active market. If not, then the debt instrument will be on subsequent measurements carried at amortized cost, where the interest receivable based on the effective rate will be recognized in the P&L account. So for the debt instrument, it depends on what is happening in that regard. If it is traded on the stock exchange, then it will be carried at fair value through P&L or fair value through OCI. If it is just a standard debt, then it may be carried at the amortized cost schedule. And you know the amortized cost schedule already, in which case we are going to be calculating the interest receivable based on the effective rate in the question. If we don't have effective rate and you just have one rate, then that is your interest. You calculate that and that will be credited to the P&L account, meaning you add it. You don't take it to finance cost because we are not the ones issuing, we are the ones buying. So it's an interest income that we will recognize. So that is the idea or the walkthrough about financial asset. Then we look at the other side of the coin. Are we issuing? Are we raising debt? Or are we selling? We can recognize either equity or financial liability. To determine whether what we are issuing or selling or whatever the heck it's an equity or liability, we ask ourselves the golden rule question: does the entity have an obligation to repay? All right. If the answer is yes, the entity has an obligation to repay, then it's a financial liability. If the answer is no, then we'll recognize it as equity instrument because it's issue of shares, and that is all in that particular case. Now, if it is a financial liability, note that the initial measurement is going to be the proceeds that we got, or if you want the fair value of the amount, less transaction cost. That becomes the initial measurement. Very important. So, Nhyira, how do you treat transaction cost? Immediately you ask such a question, you don't know what you are talking about in the first place. So, if it is a financial liability, our entity is the one issuing, selling, then the transaction cost will be subtracted in arriving at the initial measurement. If it is a financial asset, our entity is the one buying, the transaction cost may be written off in the P&L or added in the initial measurement of the equity instrument, depending on whether the entity is carrying it at fair value through P&L or at fair value through OCI. That is the principle there. That's the principle there. Very sweet, simple, straight to the point. And so that is IFRS 9. That's all you must understand. Financial asset, financial liability, we done. Then there is issue of loan notes. Convertible loan notes. Okay, issue of convertible loan notes. If an entity issues a convertible loan note, then in accordance with IAS 32, financial instrument presentation, there are two components there. So we have to split the proceeds into debt and then equity, right? The debt component is simply the present value of the cash flows on the debt, discounted at the interest rate of similar bonds without conversion right, or the, the effective interest rate. So that the balancing figure will become the equity. If there is any transaction cost, we are going to be sharing that between or allocating it between the debt and the equity component. And then on subsequent measurement, the debt component will be carried at amortized cost. And then, you move ahead with your discussion in that regard. The equity component will remain in the books until, the redemption date. We've spoken about this as well. So that is how we deal with issue of convertible loan note in accordance with IAS 32, financial instrument presentation. So that is financial instrument. It's a big thing that we need to understand. We may have a question about it, or we may not have a question about it specifically, but we may have to apply a principle to a certain note because it's going to be embedded in it. And that is what leads us to the second one, IFRS 15, revenue from contract with customers. Another primary accounting standard you must know about heading into the exam hall tomorrow. The 5-step framework for revenue recognition is a theory the examiner can ask you, so please make sure you go through that. Because when it comes to IFRS 15, there's a 5-step framework for revenue recognition: identification of the contract, identification of performance obligation, identification of the transaction price, and then allocating the transaction price to the performance obligation using the standalone prices, and then you recognize revenue as and when performance obligation is satisfied. And so these are the 5-step framework. It's a theory question. The examiner can ask you. You got to be on the lookout for that. But beyond that, there are a couple of things that you need to understand generally in that regard. For instance, if an entity sells goods, okay, so sale of goods with repurchase option. Stay with me. The entity sells goods with repurchase option. It means this is not a sale, okay, but instead it's a financial arrangement. So what does that mean? It means that we will not apply IFRS 15 to this kind of situation. What will we apply? IFRS 9, financial liability. What it means is that the entity has sold the goods. The entity has used the goods as a collateral facility for some money. So that is what we mean by sale of goods with repurchase option. So it is not a sale, but a financial arrangement. So we don't apply IFRS 15, we apply IFRS 9. And so if they have already included the revenue in the revenue, the cost in the cost of sales, you got to remove all that. So the sales proceeds will be debited to the revenue, and then you credit financial liability because you are not supposed to recognize revenue, you recognize financial liability. Then the cost of the inventory will be taken out of cost of sales and added to the closing stock because the entity said they have sold it. So the cost of that inventory is not yet in the closing stock of the entity. So what do? We add it. And so it is not a sale, it's a financial arrangement. So we have to reverse the amount in revenue, take it out. Amount in cost of sales, take it out. The cost of the inventory is not included in the closing stock, so go and add it to the closing stock. Then you recognize financial liability and you calculate finance cost on it, which will go to P&L account. Then the proceeds you got plus the finance cost becomes the carrying amount of the debt that will go under current liability on the face of the statement of financial position. So sale with repurchases option, you don't apply IFRS 15, you apply IFRS 9. So that's one thing you must understand. Then, still in line with the standard, where performance obligation goes beyond one accounting year, you saw us solving that as well during our mock sessions. You're going to go through the steps that we discussed. So you calculate a profit or loss on the contract, which is going to be your contract value, less the total contract cost, right? If it is a loss, then you make provision for that loss because it is an onerous contract. And so as per IAS 37, provisions, contingent liabilities, and contingent assets, we provide for it in the financial statement of the entity. Boom, we're gone. Right? But if it is a profit, then we have to find out how do we share that profit. And that is where we have to calculate the percentage of completion. And again, if you remember, we can use the input method or the output method. We discussed all of these during our mock session, solved questions about them. So these are the things that you must understand. When performance obligation goes beyond one accounting year, it's also, you must understand that principle in that particular case. Then another thing is if the entity make a sale on credit and the customer will the customer will make the payment at some times in the future and we have the interest rate available. Okay, and we have the interest rate available. It means that sales revenue has two components, the finance income and then the revenue item. So you discount the amount the person is going to be paying you into present value using the given interest rate. Now that present value becomes the revenue amount. So the difference between the present value and the amount the person owes us becomes the finance income that will be recognized as income over the period of the time that the person is going to be making the payment to us. So that is also another thing, that we need to understand. All these are principles and IFRS 15 that we need to know about in that particular case. But remember, all these put together, revenue is recognized when a performance obligation is satisfied. Okay, when a performance obligation is satisfied. Then the last thing there will be IFRS 16, leases. It depends. The examiner can, because there are three people, IFRS 16, IFRS 15, IFRS 9, three of them. The examiner always get goosebumps about these standards. You may go tomorrow and there is nothing about these three standards in the exam hall. Don't take it personal. It's the examiner's dance. You don't determine what the heck he brings, but you have to know about them because at least one of them will be there. Or if the examiner get excited with you, he's going to bring all the three. And that is a hallelujah there for you to go at the end of the day. Now, in IFRS 16 leases, you know what we are supposed to do here in the lessee accounting. We said that lessee has two options, either the low value approach or you go with a standard or default approach. The low value approach is where the lessee elects to treat the lease as normal rental. So although it is a lease, the entity has elected to account for it using the low value approach. In that case, there is no need for us to recognize right of use, recognize lease obligation. The annual lease payment will just be written off in the profit or loss account. Evil. We are done. That's it. But if the entity is applying the default method, then that is where we would have to recognize the lease assets and then recognize the lease obligation. Remember the issue about the initial measurement of the right of use, which is the lease asset, and then the lease liability. They may not be the same figures. It's important you know how to arrive at all of these. And we've spoken about some of these. You can also check the summary videos on the portal on these as well. Then in the lessor perspective, the lessor has a right, or it is the lessor who classifies the lease as a finance lease or operating lease in that regard, and then we apply the lessor accounting. But the key thing you must understand about leases is when the heck are we making the payment? Because that will determine how your amortized cost schedule will be prepared. And we discussed this already, that when payments are made at the beginning of the year or in advance, then our amortized cost schedule we will do for only one period or 1 year. Then the carrying amounts or the balance brought down will be splitted into current and non-current. The annual lease payable is the current. The balancing figure becomes non-current. But where the entity makes payment in arrears, meaning at the end of the year, then you will do the schedule for the current year and the next year, 2 years. Now, the next year's balance brought down becomes the non-current liability. Then the difference between the brought down of the first year and the brought down of the second year, or the brought down of the current year and the subsequent year, becomes the current liabilities as well in that particular case. So these are some of the things that, we can us take away as well when it comes to some of the things that we need to understand here. Remember, another fundamental accounting standard you're going to be applying is this guy, impairment, IAS 36. Whether you like it or not, you're going to be applying it in the exam hall. So you got to make sure you understand all the principles about impairment. Either you have a dedicated question on it, or it will be embedded in the footnote for you in business valuation, in financial reconstruction, in consolidated financial statements, or in the single entity financial statements. So IAS 36 is also one of the accounting standards you must know about. It's simple. We say that an asset has suffered an impairment when the carrying amount exceeds the recoverable amount. If you remember, we said the recoverable amount is simply the higher of the value in use and then the fair value less cost to sell. Again, if you remember, we said the value in use is the present value of the future cash flows discounted at the pre-tax cost of capital of the entity. Pre-tax. The examiner can play on your intelligence and bring you the pre-tax and post-tax. You don't sit there and be like, oh, which one can I use? Oh my God. Debbie. Pre-tax. Pre-tax cost of capital. Remember, the cash flows are maybe in two folds. That is, the annual cash flow that we get from the usage of the asset, and then the proceeds from the disposal of the asset at the end of its economic useful life. So you got to be careful about the context of the question, but that is value in use. If we are supposed to calculate, the data is going to be given so we can do the calculation there in that particular case for our question. Then the fair value less cost to sell is what we will get if we should sell the asset today, right now. What are we going to get? That's fair value less cost to sell in that regard. So we compare that to, we pick the higher one, and that becomes recoverable amount. Note, if the recoverable amount is greater than the carrying amount, the asset has not suffered an impairment. The asset will still be carried at its carrying amount. Don't go and do revaluation surplus. If the recoverable amount is greater than the carrying amount, the asset has not suffered an impairment. The entity will continue to carry it at its carrying amount. But the last thing about impairment here is, if we are dealing with a cash generating unit, which is a business, a segment of a business, or a group of assets. If we are dealing with a cash generating unit, then the thing we must understand is about allocation of the impairment to the individual assets and liabilities of the entity. If you remember, we said we will first write off separately identified impaired asset. So in the question, the specific asset that have suffered an impairment, we will write them off. If we still have some of the impairment loss left and there is goodwill, we write off the goodwill. If we still have some of the impairment left, then we will share it or allocate it among the remaining assets that have not suffered impairment yet on a pro rata basis. Note, things like receivables, payables don't suffer impairment, so you're just going to bring the same amount at the end of the period. So that is also something you need to understand, IAS 36 impairment. Remember, in consolidation, goodwill can suffer an impairment. And there are two ways the examiner can play on your intelligence. Either he will tell you that, oh, goodwill has suffered an impairment by 20%. So it means your goodwill at acquisition, you take 20% of that. That is the impairment. Or he will give you the figure directly as the impairment in goodwill. Or he will give you data about the subsidiary at the reporting date for you now to calculate the impairment, applying this principle here. So it will give you the value in use and maybe fair value less cost to sell, and then the carrying amount at the reporting date. Then you will determine whether the subsidiary has suffered an impairment. If it has, then you can write that off against the goodwill in that regard. So that is why this accounting standard is also another pivotal standard that you will apply anyways, because it may be in consolidation, it may be in the single entity. We could have a dedicated question on it, or it will be, in financial reconstruction or corporate reorganization or business valuation in that case. So it depends on the context of the question and how you dance. But IAS 36, you got to make sure you understand it in that regard. Then, the rest of the other standards, at this point, it is hoped that you understand the principles on each of them. IAS 37, provisions, contingent liabilities, contingent assets. IAS 38, intangible assets. Remember, intangible assets, we subsequently account for them based on whether they have a definite economic useful life or an indefinite economic useful life. If the intangible asset has a definite economic useful life, then we amortize it over the economic useful life. If it has if it has an indefinite economic useful life, then we test for impairment. Remember the treatment of research. Remember the treatment of development. Remember the treatment or recognition of goodwill. We can only recognize goodwill arising from business combination in accordance with IFRS 3. However, internally generated goodwill cannot be incorporated or recognized in the financial statement. So these are principles. You got to make sure you understand them very well. Certainly, as I told you on Friday, IAS 2, IAS 8, IAS 10, these are not standards you're supposed to be thinking about because they are default standards. When you sleep and wake up and you are asked, you should be able to talk about IAS 2, IAS 8, and IAS 10 in that case. So these are also some few things that you must understand on that spread that the examiner is going to be having for you, on the party that he's going to be throwing for you when it comes to dealing with the accounting standards. It become a little bit even challenging for you in the corporate reporting class because in business valuation, you know this, we've done this in class, when you are valuing the business, the footnote will override the carrying amount. And in the footnote, you are applying accounting standards. So if you screw up with the accounting standards there, it means your business valuation, it's already in the mud as well. So you have to be mindful on the business valuation workflow and then the standards as well in that case. So these are some issues that you must understand as you review and re-strategize yourself for the standards, but it's going to play a key role in the exam hall. You will pass or fail the exam based on the accounting standards, so you want to make sure that you are really familiar with them by tomorrow morning 9 a.m. or in the afternoon by 2 p.m. So that's also our accounting standards, 40% coming in the exam hall that we need to know about. It depends on the context of the question, but these are some standards that I want you to really be mindful of and then pay attention to as you go into the exam hall. The final thing probably that I want to share my thought on will be on question 1, consolidated financial statement. As I told you already, I've given you the blueprint on what I expect you to do. I'm not going to be repeating that again, but you don't want to answer the consolidated financial statement question first. I've told you already, I don't care how sharp you think you are when it comes to consolidation. You want to attempt that as your third, fourth, or maybe last question, and you want to pick the easy marks. So when it comes to consolidation, what the heck are we looking at? Couple of things I want you to take away here. Number one, certainly going to be the easy peasy, the group structure. And most importantly, determining your date of acquisition, which will be in the question ultimately. And then number 2, it's going to be the post-acquisition period. You got to be careful of that. The post-acquisition period, very important. But sometimes the examiner will not give you the percentage of acquisition. You have to calculate it yourself. Okay? So not all the time will the examiner give you the percentage of acquisition. Sometimes he will just tell you, whatever, Adepa, acquired 4,000 equity shares in Kukua. Okay. So it means Adepa is the parent entity, Kukua is the subsidiary. But this 4,000 shares, what percentage does it give them? So you go and look for the stated capital of the subsidiary and get the number of shares. And then you do the 4,000 divided by the number of shares times 100. That will tell you about the percentage of acquisition, whether it's an investment in associate below 50% and in that regard, or it's a true subsidiary. So sometimes we may not be given the percentage of ownership. We'll just be told the number of shares the entity has acquired. Then we have to do our own calculation to determine the percentage of ownership given in the question. But that is our easy peasy group structure, date of acquisition, post-acquisition period, percentage of ownership. Very important. You need to know about that. Then we come to the second part, which is going to take a lion's share in the exam hall for workings, and that is goodwill. Very important. Goodwill. It depends on the context of the question. We may need goodwill at acquisition. If we are doing statements of financial position, then we need goodwill at the reporting date. But when it comes to calculation of goodwill, there are a couple of things you need to know about how to calculate fair value of consideration transferred. If you remember, we said there are 4 elements of the fair value of consideration transferred. 1, cash consideration. You don't need a miracle on that. The entity paid S amount of money per shares acquired. You bring it up. Number 2, we could have deferred consideration or contingent consideration. In either case, we just apply IAS 37, provisions, contingent liabilities, contingent asset. The difference between the two is that deferred consideration is an additional payment to be made to the shareholders of the subsidiary in the future. But contingent consideration is an additional payment to be made subject to meeting certain conditions. That's the difference. That's the difference. So usually in the deferred consideration, we would discount it into present terms in accordance with IAS 37 and add the present value to the fair value of consideration calculation. Then on subsequent measurement, we calculate the finance cost or unwinding, which will come in P&L or group retained earnings. Then the carrying amount will be taken to the statement of financial position, which will be the present value plus the unwinding. When there is contingent consideration, sometimes the examiner will tell you to ignore time value of money. And so in that case, whatever that is going to be paid, that is what you will bring to the fair value of consideration transferred. If it happens that at the reporting date, the subsidiary is not able to meet the condition, then a reduction in the contingent payment is an income. So if the entity at the date of acquisition had mentioned that they're going to pay whatever the heck, 4,000, but at the reporting date, they say due to poor performance, the entity will pay 3,200, then the remaining of 800 is an income. And that will be recognized in consolidated P&L under other income or added in group retained earnings if we are doing consolidated statement of financial position. So that is the difference between contingent consideration and deferred consideration. Very important. Then we will have cash consideration, contingent consideration, deferred consideration, then share exchange. This is where the parent entity is issuing shares to the subsidiaries' shareholders. So share exchange, the exchange policy will be stated in the question, but because the parent is the one issuing the shares, we will use the share price of the parent to get that fair value in that case. If it is not recorded, we have spoken about this, then you're going to record that if we are preparing statement of financial position and split it into share capital and share premium for the period under review. And that is all. Then the last thing is issue of loan notes, because with issue of shares, it may bring about dilution in control, dilution in ownership for the parent shareholders. So sometimes we would rather issue loan notes. If we issue loan notes, it's a financial liability, so we apply IFRS 9. The proceeds from the issue will be added to the fair value of consideration transferred, and then we'll calculate finance cost on subsequent measurement, and that will be in finance cost, consolidated P&L, or subtracted in finance cost in the retained earnings if we are doing consolidated statement of financial position. So these are the 4 or 5 things, if you want to, under the fair value of consideration. I don't know what the heck the examiner is going to do to you in the exam hall, but it is important you understand these principles very well. The second item that is important there is non-controlling interest calculation. There are 2 ways to calculate non-controlling interest. Either it will be at fair value based on the share that they own in the subsidiary, or the figure will be given to you directly in the question, or on the proportionate method where the NCI value is based on the percentage of ownership in the subsidiary of the net asset of the subsidiary. Remember, when NCI is valued at fair value, then impairment in goodwill will be shared between the NCI and the parent. But if NCI is valued at the proportionate method, then any impairment in goodwill will be solely borne by the parent entity. And so that is another key principle that you need to understand there when it comes to non-controlling interest. Then the last thing is going to be your net asset. The net asset schedule in that regard. It depends. We've mentioned to you how to deal with net asset acquisition, net asset reporting date, or don't do the net asset schedule. Get your acquisition and then do the profit, post-acquisition profit or loss workings. In that case, you don't need net asset acquisition, net asset reporting date. But there's a key workings I want you to take away, because retained earnings at the date of acquisition may not be given. And so you have to know how to calculate it. And you remember when we did the mock, some of you had problem with this. Let me just emphasize that again. Retained earning at acquisition, if it is not given, how the heck do you get that in the question? Simple. You just bring the retained earnings at the reporting date, which I would say balance brought down, or let me say at reporting. All right. Then, if they made profit, okay, so you're going to bring profit or loss. If they made profit for the year, so stay with me here, because this is where some of you screwed me up. If they made profit during the year, then that profit was added in arriving at the closing figure. So we will come and what? Subtract it. If it was a loss, then it was subtracted in arriving at the closing figure. So you come and what? Add it back. Very important. So you're just reversing what has been done based on the profit of the entity. Now, if it happens that it is midway acquisition, then it is important for us to then go and add back the pre-acquisition profit for the year. That will also be brought. Then the net figure is what gives us the retained earnings at acquisition. So if it is not given, that's how we dance. That's how, and we've done this in class. You've seen it in questions, and some of you screwed me up, and we did the correction. So please make sure you look at that very well, because it's an important workings for your goodwill. Because if you don't get this, it's not given, and you don't get it, then your goodwill is au revoir, mes souhaits. Then you're going to lose that 3 to 5 marks or whatever the heck that the examiner is going to be allocating to the goodwill. So please go back to this to get a retained earnings at the date of acquisition as well in that regard. Once we get our net asset, we get our goodwill coming up. Remember, goodwill can either be positive, which is the normal way, or negative, which means it is a gain on profit, right? Did I say gain on profit? It's a gain on acquisition, okay? Now, if you calculate the goodwill and it is negative, then that is a gain. So if we are doing consolidated P&L, just add it to the consolidated P&L. It comes there as an income. If we are doing consolidated statement of financial position, you add it in the group retained earnings. All right? Because negative goodwill means we paid less than the value of the entity, and that is an income. There is a theory question about this. Why will this be negative? And we've discussed this. Maybe because of better negotiation, or maybe it's a for sale, or under a forced transaction, for sale, or maybe the owners of the subsidiary do not know the value of the company. These are some of the reasons why there could be a negative goodwill. Then there's another question that says that, theory, how do you treat the negative goodwill? That's what I just told you. It is a gain on acquisition, and so recognized as an income in the consolidated P&L, added to group retained earnings in the consolidated statement of financial position. Then the last question, still about this whole goodwill, is what should the entity do when goodwill is negative? So 3 questions, theories. Why will goodwill be negative? Number 1. Number 2, how do you treat negative goodwill? Number 3, what should the entity do if goodwill is negative? And we spoke about this also in class. We said we have to revalue the fair value of the net asset of the entity. Maybe we did a mistake, so we do the revaluation. Number 2, we revalue the fair value of the non-controlling interest, because maybe there is an error in terms of the calculation in that particular case. Then we reassess the computation of the fair value of consideration transferred, because probably there are various components and some of the components were messed up in the calculation. So what should the entity do when goodwill is negative? These are some of the things. So on that stretch alone, 3 different theory questions that the examiner can throw at you. Remember, there is a theory on consolidation that you must know about, as I shared with you on Friday during our final session. As in the theories, there is a consolidated financial statement theory that will be waiting for you in the exam hall. So that is our key second workings that we must understand. How we deal with fair value of consideration, how we deal with NCI, how we deal with the net asset schedule, and most importantly, how we calculate retained earnings at acquisition if it is not given. Then certainly, the goodwill, if it is negative, what do you do? And the other theories about it. The third key workings, number 3, it's going to be, now, there is one thing I need to talk about here, sorry. In the goodwill calculation, the 4th thing there is fair value adjustment. Make sure you don't screw this up. Whether you like it or not, there will be some fair value adjustment thing going up. And the examiner has a lot of options available. As you remember on Friday, I was sharing some of the thoughts with you. They can say, oh, there was a liability that was not recognized. Now let's recognize it. Oh, so in our net asset schedule, liability reduces the net asset, so you come and subtract it. Oh, there was a borrowing cost that they were supposed to have included, but they have not included. Oh, in accordance with IAS 23 borrowing cost must be included in the initial cost of the asset. So what they have not included, we will bring it, add it to the net asset, but we have to calculate post-acquisition depreciation on it, because remember, when you include the borrowing cost in the initial cost of the asset, you calculate depreciation. So these are accounting standard stories that examiner can chase you down in consolidation, and nothing is changing here. You got to make sure you understand it. I mean, that's it. Corporate reporting students, the examiner could escalate that to IFRS 2, share-based payment. As you know, we've done something about that. We solved questions about that, the comprehensive consolidation question that we solved. And then the IAS 19 employee benefits. So that fair value measurement thing, there is no one way fits all. You just have to pay attention to the context of the question and understand what is happening there. But the examiner may call on you to apply some accounting standards there, and you have to make sure you apply it well. Again, this is why I said, do not answer consolidated financial statement question well. First. Number 2, don't go and be in a hurry to go and extract any financial statement. Nobody is interested in your financial statement extraction. Do your workings. By the time you get here, it's your question 4 or your last question, and you're doing some of these workings for some easy marks and go away. Then the third thing that really will be important is the treatment of intra-group trading. Very important here. It's not always that the examiner gets goosebumps on intra-group trading. Corporate reporting, you may go there and there is no intra-group trading. Financial reporting students, all other things being equal, there is going to be intra-group trading waiting for you. It's a regular customer there. So you got to understand the principles, and we went through this as well. Number 1, we said all post-acquisition sales must be eliminated from the revenue and cost of sales if we are preparing consolidated P&L. Keyword, all post-acquisition sales. So if they've been trading among themselves before we acquire them, I know they fire. But when we gain control to the year ended, the total sales must be eliminated in revenue, in cost of sales. You subtract the same figure. Number 2, any goods that have not been sold yet and remaining in the books at the reporting date, what do? We calculate post-acquisition profit on that goods. And how do we treat post-acquisition profit? If we are preparing consolidated P&L, then we'll debit cost of sales. If the subsidiary is the one selling, then we will debit their profit for the year, meaning you subtract it from their profit for the year. If the parent is the one who is selling, then we are going to be debiting group retained earnings, meaning subtracted from group retained earnings. Because group retained earnings is an income account, has a credit balance. So when we say debit it, it means go subtract it. Then you credit it from inventory. So if you are preparing consolidated statement of financial position, then the inventory for the year, we're going to subtract the provision for unrealized profit, which is going to be the goods that have not been sold yet. Remember, provision for unrealized profits can be calculated on 2 things. Number 1, goods in transit, as well as unsold goods that have been bought from the subsidiary or the parent, depending on what is happening in the context of the question. So number 1, if we are preparing consolidated P&L, all intragroup sales, post-acquisition intragroup sales to be eliminated. Any goods remaining that has not been sold yet, bought from the related party, we must calculate provision for unrealized profit on it and deal with it in the manner that it has to be dealt with, depending on what we are doing. Then we'll credit the inventory in that regard. Then the next thing will be the reconciliation of the current account, because remember, nobody is supposed to owe someone. Consolidation is preparing the financial statement for a single economic unit. So the parent cannot owe the subsidiary cannot owe the parent. So at the reporting date, any debt that the parent owed the subsidiary must be eliminated from the current liability, and any amount that the subsidiary also owes must be eliminated as well. It depends on the context of the question, but the key thing is that any debt outstanding between them in respect of trading must be eliminated in current asset and in current liabilities, or to be specific, trade receivables and trade payables. Please, this doesn't apply to deferred consideration and contingent consideration that we spoke about. The deferred consideration or contingent consideration or the loan notes that we issue to facilitate the acquisition, that one is debt owed to the shareholders. So it will still come on the face of the statement of financial position. What we are cancelling here is the debt between the parent and the subsidiary. That's the reconciliation thing that we are talking about. So that is the idea about intragroup trading. They could sell assets among themselves, non-current assets. If they sell, again, nobody shall make profit over somebody. So we're going to reverse the transaction. And we've spoken about this. So number 1, you're going to calculate the provision for unrealized profit or loss and remove it from the books of the person who sold the asset. So if the parent was the one who sold the asset, let's say parent sold the asset to the subsidiary, and the current amount of the asset was 10,000, and the subsidiary, the fair value was, say, 15,000, then that means that the parent had recognized 5,000 in their books as a gain from this sale. What do? We reverse it. So this is a profit, so you reverse it. How do you reverse? Since it was a profit, it has been credited to the account, so you're going to debit the profit or loss, and then you credit PPE, with that. If it was a loss, you will reverse it in that particular case to do the treatment. Then in the books of the subsidiary, they will be carrying the asset at 15,000, and so they will charge depreciation based on that 15,000. But as a group, depreciation should have been charged using the carrying amount and not the fair value figure. So we would have to calculate that excess depreciation and reverse it as well in the books of the subsidiary in that regard. So it depends on who is selling, but you're going to cancel first the profit or loss on the sale in the books of the one who sold it. Then the corresponding entry will be adjusted for in the PPE. Number 2, either they will charge more depreciation or less depreciation. So you calculate the excess depreciation and reverse that also in the books of the one who bought the asset, the corresponding entry to be adjusted for in PPE. That is how you deal with sale of assets as well in that case. Again, it depends on the context of the question. Usually what we see is the goods issue and goods in transit and reconciliation. But if the examiner get excited, get some goosebumps, then we will go to sale of assets between the partners or among the partners in that regard. So these are also some things that we need to understand when it comes to the issue in respect of consolidation. That's all. We are done. So your group structure, date of acquisition, post-acquisition, percentage of acquisition. Number 2, your goodwill calculation. A lot of things will be going down there. Make sure you get the principles as stated. Number 3, intra-group trading. Got to know how to deal with them in that regard. Now, for corporate reporting students, this will be escalated a little bit depending on how excited the examiner is to deal with a complex group. And we've spoken about the things that you must understand there. If the parent owns a subsidiary and the subsidiary also goes to acquire sub-subsidiary, then it is important we calculate the controlling interest in the subsidiary, in the sub-subsidiary, and we calculate the NCI in the sub-subsidiary, the way that calculation is supposed to be done. We've spoken about it. We said that any investment the subsidiary makes, both the parent and the NCI have their percentage of ownership in that subsidiary. So if we have 25, maybe let's say 57% here, NCI will be 43, right? And the subsidiary goes to acquire 70% of this. So to get a controlling interest in the sub-subsidiary is going to be what? Their ownership of 57% of 70%. So that 100%, the balancing figure will be the non-controlling interest in the sub-subsidiary. That's the principle there. So the way we calculate NCI in the sub-subsidiary is going to be different. It depends on the group structure because sometimes the parent may have a direct investment in the sub-subsidiary. And so what we did here is the indirect investment. You add that to the direct investment, you subtract that from 100%, and that gives you the non-controlling interest. Please note, you may do the controlling interest and it is less than 50%. That doesn't mean we can't consolidate the sub-subsidiary's financial statement, because if the subsidiary owns more than 50% of the sub-subsidiary, then we control the company that controls them. So even if our indirect ownership in the sub-subsidiary is less than 50%, we will still consolidate their financial statement. So you got to be mindful there when it comes to dealing with the issue about a complex group structure. Then, if you remember, I told you about how we're going to calculate goodwill in the sub-subsidiary. Goodwill in the sub-subsidiary. We said the fair value of consideration transferred will be the parent's ownership of the sub multiplied by the fair value that the sub paid to the subsidiary. Very important. So goodwill in the sub-subsidiary calculation, that's how you get your fair value of consideration transferred. Goodwill calculation in the subsidiary, that one is the normal approach, no problem. It is the goodwill in the sub-subsidiary that you have to be mindful of, generally. Then the second thing exclusive here is the non-controlling interest in the subsidiary. When doing non-controlling interest in the subsidiary, you bring your fair value of NCI at acquisition, then you will less the NCI's share of the fair value of consideration transferred that the subsidiary paid the sub-subsidiary. So we less the investment of the NCI in the sub-subsidiary, which is going to be percentage of ownership of the NCI multiplied by the fair value of consideration that the subsidiary paid for the sub-subsidiary. So if you pay attention closely, in the goodwill calculation, you brought the parent's share of the money that the subsidiary paid the sub-subsidiary. So the remaining of that money is what you are subtracting from the NCI in the subsidiary. Calculation of NCI in the sub-subsidiary is the same thing that you know. So these are the two things that you got to be mindful of, and we've spoken about this. They are the principle you need to understand. In foreign subsidiary also, we've mentioned the various exchange rates. If we are doing consolidated P&L, we use the average exchange rate. Consolidated statement of financial position, we use the closing exchange rate. Consolidated cash flow, we use the average exchange rate. Then any transaction that occurred, we will account for the transaction as acquisition at the reporting date using the exchange rate applicable in accordance with IAS 21 effect of changes in exchange rate. So in that consolidation environment, these are the encumbrances that you need to understand, basically, for you to excel there in that case. Again, that is why I said the approach is, as you get to the exam hall tomorrow, we are going to be having 20-mark questions on theories. Okay, 20 marks, as I illustrated to you on Friday. Conceptual framework for general purpose financial statement. FR students especially, 5 marks is waiting for you there. Accountants and ethics. We discussed this on Friday. If you remember, we solved a question about that. 5 marks may be waiting for us there. Then the consolidation theories. Okay. Entities that have control but cannot prepare consolidated financial statements. So exemptions from the preparation of consolidated financial statement. 1, the entity's shares are not listed, publicly listed. Number 2, the entity's debt instruments are not publicly listed. Number 3, the entity is not in the process of getting any of its instruments listed. And then number 4, the entity's financial statement is part of another entity's financial statement that prepares consolidated financial statement available to the public. So those are the exemptions. It's a question the examiner can access as part of the theories that we need to know about. And then certainly sustainability and IT issues. And then the IFRS foundation, how we set standards and those things. You want to make sure you glance through them. The examiner could throw something at you there in that regard. Then I've told you this already. The accounting standards, we may have a theory question exclusively there on the accounting standards that we need to know about and we should be able to answer in the exam hall. So the approach generally, as I said on Friday to you, is to take out all the written questions first, right? Take out all the written questions. Then, if you pay attention closely to the ratios, it's going to be an easy peasy. So from there, you can decide what the heck you want to take, ratios and those things. please, those of you in the corporate reporting class, you know that either we will have business valuation or financial reconstruction, corporate reorganization. Please make sure you have read through the business reorganization, sell off, spin off, management buyout, management buy-in, those theory things. Make sure you read them before you go to the exam hall. It's one of the theories the examiner could bring for you, corporate reporting exclusive. Then in business valuation, be mindful of the basic principles. Under the net asset schedule, under the asset method, what do? All liabilities are liability, including preference shares. They are liabilities. But assets whose recoverable amounts cannot reliably be measured will not be included. For instance, goodwill, it's not included in determination of the net assets of the entity. Again, make sure you go through the principles for PE ratio, how the adjustment is done, and the basis for the adjustment. Write the assumption you used. If we don't have it clearly in the question, write it down. Earnings yield, write your assumptions down, and then you'll be good. Dividend yield and those things. Remember the cash flow method that we use the pre-tax and depreciation cash flows. So you look at the question we solved in class about it and discussed this, and many of you screwed it up and we corrected you. So pay attention to that very well, because if we are giving the cash flows after depreciation, then you have to add back the depreciation. But if the cash flow is before depreciation, then you just pick that figure and run with it and do your work. So be mindful of the cash flow method, because if you miss the cash flow and you go and pick the wrong amount or do the wrong adjustment, au revoir may sway for you, you're going to get it wrong at the end of the day. Then suddenly you come to the financial reconstruction. Remember, either the examiner will say we should just deal with liquidation. Hallelujah. Bring your proceeds, do the sharing. Remember the sharing principle. You bring your liquidity expenses, if there is any. Then you bring your secure debt. But even under the secure debt, you bring first the fixed charge secure debt, equivalent to the fair value of the net asset or the asset that they are using to back the principal there. Remember that. Then you bring the floating charge debt. Then you can follow. All other debts will be treated as unsecured debt, and the money left will be shared on pro rata basis among them. So please be mindful of the principles about liquidation. Then when you finish, you write the English down. Under the liquidation, the major stakeholders, what everybody is getting. Right? What everybody is getting. Then, if we are going to do reconstruction, you know the deal already. If we're going to do reconstruction, no problemo. Definitely, you're going to prepare the capital reduction account, whether I like it or not. Whether the examiner says it or not, you're going to prepare it. Sometimes the examiner will say, calculate the maximum gain or loss under the scheme. It is the same as the capital reduction account. Note, the capital reduction account serves only one purpose, and that is to complete the double entry principle and make the various adjustments that has to be made when it comes to reconstruction. So be mindful of the footnote. I think yesterday, some of you asked questions about the ICAG mock, and then we gave the clarity on the various treatment of the items and why some things were done the way they were done. Follow the principles we discussed in class and read the notes one after the other and understand the context of the question. So that is also something I want you to understand exclusively for corporate reporting students, business valuation, corporate reconstruction, financial reorganization. And so in the exam hall, take away the theories first. Make sure you're not answering two different questions on the same page, but you want to take out all the theories first. Then from there, you can go to the evaluation of financial statements. You can go to the standards. You can go to single entity. You can go to business valuation, whatever the heck. Then your consolidation should be your last but one question. Again, that is my recommendation. But if you get to the exam hall and something comes over you and you get excited and you want to do the consolidation first, I hope that you will be able to pass the exam, but your chances of passing the exam just became very slim by you deciding to solve the consolidated financial statement question first. Because you're not going to thrive in 36 minutes for the consolidated question. You're going to need more than that. And so that is why you should answer the theories first, go to the other questions first that you can do best first. You come to consolidation, you want the easy marks, group structure, goodwill calculation, intra-group trading. Just do the workings and let's go. And so putting all these together, as you know already, I told you on Friday, you're going to make sure you work with speed and accuracy in the exam hall. You only start thinking in the exam hall 15 minutes or 30 minutes to end. That's when you start thinking. You can't get to the exam hall and start thinking, because immediately you start thinking, you are failing the exam. How can you reduce the time of reading and starting the question? By making sure you have a formidable understanding on the various things that we have spoken about and others that are available in the syllabus. And so those are the things that we need to understand. I've spoken about the standards issue. I've spoken about interpretation of financial statement. I've spoken about the theories that we need to have an understanding on. I've spoken about the basic principle issues on consolidation, and then financial reconstruction, corporate reorganization for the corporate reporting students also that you need to understand. So there you have it. That is financial reporting and corporate reporting. Now, to some of you, you're going to feel overwhelmed because some of the things probably you might not have done them or you're not formidable with them. Don't freak out. That's not my goal here. So I don't want you to be afraid. You still have some few hours to go. From here, go and sleep. Get up tomorrow morning and go and write the exam. Okay? Just sleep. Nothing will happen to you. You've learned. Sleep because you need a lot of rest. But some of you, it's now that you are going to sit down and drink coffee and go and put your leg in hot water. Because you have mental fatigue. So chill. From here, just go and bath and sleep. Tomorrow morning, you get up, eat breakfast. Have a chauffeur drive you to the exam hall. You are relaxed. You just chill, cross your leg, take in maybe your tea, and then you're just flipping through the books. It's swag. This season is swagging season. And you have na uko suya de uko solve question bia obedi echiri bia yense munu na udi. Just get into the principles, flip yourself through it. You'll be good in that particular case. All right. So these are some of the things that I would recommend that you do as per best practice. Theories, ratios, go to the other things, work with speed and accuracy, and make sure you go to the exam with a good calculator. Okay. Some of you, the kind of calculator you use even will make you fail the exam because you can't move with speed and accuracy. You punch like crocodile. You punch like you are a tortoise. It's only 3 hours, guys. So speed and accuracy will be your best friend in the exam hall. And, these are some of the things about that. I'm going to be wrapping up around here so that I can leave you guys to go and sleep. And tomorrow morning, have a fresh knowledge to be able to go into the exam hall. If there is any other thing, I don't know, I'm seeing some quick comments coming on YouTube. Let's see if I can address them. Can one lose marks if you misquote a standard? For example, you quote IAS 40 investment property when they mean IAS 16 and is quoting standard mandatory. Yeah, if you misquote standard, you are wrong. It's not like you are losing marks. You are wrong. Because if you quote IAS 40, but what you are explaining is IAS 16, you are wrong. It's not like you lose marks. You have lost the entire marks allocated to that question. Is quoting standards mandatory? Yeah. Why are you writing? In accordance with this standard, this is how it's supposed to be done. Yeah. So you have to quote the standards if you are required to explain or discuss the question in that particular case. What the heck do I have? One paper left here. Nhyira Premium stands for level 2 and advanced taxation in level 3. Okay. Oh, what else do I have, please? Any sustainability information is new now. I don't understand. Yeah, there is sustainability in your syllabus, which I hope you have read by now. In that case, yeah, there are sustainability issues that you need to know about on how to prepare the sustainability report, the GRE's sustainability guidelines, the principles about preparation of sustainability report, and then IFRS S1, IFRS S2. These are 2 new accounting standards about sustainability, and you're supposed to know all of these as you are going into the exam hall on current issues and current development, especially for the corporate reporting students. So you're expected to know that by now in that case. Okay, so if there are no other questions, I'm going to be signing off here to leave you to go and do your things. And you go to the exam hall tomorrow, and we wish you all the best as you go, and hope that you'll be able to pass the examination. As I said, recommended best practice. Read all the questions, answer the theories first. From there, based on your knowledge and understanding, take the questions in that order. Again, do consolidation as your last but one question. But as I said, that's my recommendation. Maybe somebody else has told you something somewhere. My beard, there's no white beard inside. My stomach is not big. And I don't wear big jackets also. So, my hair too is not gray. So some of you, when I talk, you decide to pick it or you don't pick it because you have your own agenda. Whatever be the case, whatever strategy you have, I pray that it will be well with you. But the best practice on what I'll recommend to you, based on my experience over a decade in the game, is take out all the theories first. Make sure you're not answering 2 separate questions on the same page. Come to ratios. If you have built your knowledge well, ratio should not be a big deal. From there, you can come to the standards. Let consolidation be your last but one question. And the goal there is you are taking some free marks from the workings. That is the recommendations. You cannot answer all the questions, although you are supposed to attempt all the questions. 99.9% of you watching this video on this call, you will not answer all the questions. That is why speed and accuracy is also important. Because if care is not taken, by the time you hear get ready to stop work, you are on your 3rd question. There you know you have failed the exam in advance. So please, a strategy. So take out the theories. That's 20 marks. If you can get 15 of them, you've read the theories well, you can easily get 15. You can easily get 18 of the written questions the examiner will bring if you have read the theories well. Then go to your evaluations. Go to the standards. Definitely you can get some things to do. And put them together. Should be able to pass the examination. So that's my recommendation. And I'm hoping that you'll be able to go into the exam hall, write the exam with confidence, and pass the examination. Please, for those of you who are in the group of panic, fear, anxiety, self-doubt, if you are in any of this camp, I pray for you to be delivered. But beyond that, you are responsible to overcome this before tomorrow, 9 a.m. or 2 p.m. So if you're in any of these camps, panic, fear, anxiety, self-doubt, you got to kill this before you get to the exam hall. And even in the exam hall, if you start panicking, you start being anxious, you start self-doubting yourself, kill that in 10 seconds. 10. Nobody can do that for you. Because some of you, the reason why you may fail the exam is not because you don't know the material. It's because you are afraid. It's because you doubt yourself. It's because you are scared. But that is not what you are. God has not given you the spirit of fear. He gives you the spirit of power, of love, and of sound mind. Sound mind. So where is the fear coming from? You are a child of God. God is with you. Your house people cannot follow you to the exam hall. How can you be thinking like that? They can't follow you. You are the child of God. So declare positivity to yourself. If you start panicking, tell yourself, God did not give me the spirit of fear. I have the spirit of power. I have the spirit of love. I have the spirit of sound mind. I can do this. No more fear. Speak positivity to yourself and have faith. Because if you start panicking, everything you've learned will evaporate, like the way water evaporates when it is heated. So please, if there is anything I want to leave you with, beyond all the strategies or the explanation, is whatever that is going to happen from right now to the exam, and in the exam hall, make sure this camp you leave there. Some of you, you're going to get the paper. And if you get a paper, you start flipping the paper, something will strike you. It's your brain playing with you. It's not your house people coming for you. I respect you, but I don't think you've reached that level for the devil to come after you. Okay, I respect you, but the devil, no. The devil doesn't have your time. All right, I respect you, but the devil doesn't have your time. Carry yourself well because you're a child of God. All right, and don't let fear, panic, anxiety, or self-doubt come over you. Again, nobody can do this for you. You are responsible for it. If you can have faith and understand that you have sound mind, that you have love, that you have power, then you can go to the exam hall, write the exam with confidence, and pass the examination. All right? So if there's anything I'm going to leave you with, it'll be this one. Because your emotions is going to play a crucial role from now till tomorrow evening and throughout the examination. Some of you are writing more than one papers. Maybe tomorrow may not go your way. It's reality. It may not go your way. But make sure that doesn't affect the other papers. Again, it's all in your head. Make sure you overcome it. And by the grace of God, you should be able to pass the examination. So that's it about that. We'll leave you here today. And we wish you all the best as you go and write the examination. And those of you who are graduating, we'll see you 2025. And if you have other papers to write also, we will see you in December after the election. But not in FR or CR. Good night. Please sleep. I beg you, sleep. Tomorrow morning, eat your best breakfast. Tell your spouse to prepare your best breakfast, or you have a chef in the house. Prepare a nice breakfast for you. Eat. Relax. Go to the exam hall. Chill. That's it. Flex. Bye-bye. I'll see you guys some other time.